Have you ever woken up in the middle of the night stressed that your money will not last you through retirement? Do you worry that your retirement lifestyle might not match your expectations? Are you avoiding the questions altogether because of the anxiety that it causes? If you're feeling distressed about your retirement planning situation, please realize you're not alone. Many retirees and individuals who are approaching retirement face these same questions with trepidation. Hi, I'm Harry Starn, and welcome to this Starn Standard Practical Knowledge video. In this recording, I will share how numerous financial planning professionals help their clients plan for reliable and sustainable inflation-adjusted income streams through retirement. The Integrative Retirement Income Plan consists of three components: a guaranteed income floor, a growth portfolio, and longevity insurance. Before we examine these three building blocks in detail, it's important to frame three retirement risks that you need to plan around. The three risks that are critical in planning for a secure inflation-adjusted retirement through your entire retirement period are sequence risk, purchasing power risk, and longevity risk. Sequence risk refers to the threat that the timing of your retirement portfolio withdrawals occurs just when there's been a major market downturn. When your withdrawals occur following the market sell-off, you need to sell more shares to receive the dollars needed. That leaves less capital for compounding, which negatively impacts the longevity of your assets. For example, let's say the retiree has a $1 million portfolio. However, the market just experienced a material downturn which reduced the assets by 30%. The $1 million portfolio is now only worth $700,000. If you then withdraw $100,000 for living expenses, there's only $600,000 left, rather than the $900,000 if the market had remained level. There is a 33% reduction in the amount of money that you can continue to compound and fund future cash flow needs. Risk planning insight number one. Some of your retirement income needs to be insulated from the impact of market volatility. Purchasing power risk refers to the fact that a dollar today won't buy that same dollar of benefit in the future. That's because inflation negatively impacts future purchasing power. For example, an annual inflation rate of 2.5% will increase costs by 64% in 20 years. What costs you $1 today will cost you $1.64 in 20 years. The annual inflation rate for healthcare has run at about 8%. An annual inflation rate of 8% will increase your costs by 366% in 20 years. In this case, what costs you $1 today will cost you $4.66 in the future. Can you imagine the impact of quality of lifestyle for a retiree with only a fixed annual income? Risk insight number two. Your retirement income portfolio needs to be inflation-proof. Unfortunately, we don't have a crystal ball to inform us about the future. That sure would help things, right? Longevity risk refers to the chance that a person will outlive their financial resources. In fact, for many, the fear of running out of money is a greater concern than passing away early. Risk insight number three. Your retirement portfolio needs to accommodate the uncertainty of a person's actual lifetime. Creating a viable retirement income plan requires a strategy that mitigates these three risk factors while still building sufficient assets to continue one's standard of living. Retirement income planning is a balancing act. Risk management, asset growth. The image shown here summarizes an integrated three-part retirement plan that addresses that need for balance. The foundation of the plan is the guaranteed income floor, which is designed to cover a person's essential daily living expenses, putting food on the table, keeping the lights on in the house, heat in the home. Having an income floor mitigates the potential threat of sequence risk because systematic income eliminates or at least reduces the reliance on selling securities within the growth portfolio at a discount. That floor is supplemented with a growth portfolio, which maintains exposure to stocks and other assets that are expected to appreciate over time at a rate that far outpaces the inflation rate. The growth portfolio addresses purchasing power risk. Longevity insurance is a deferred annuity which does not kick in until some advanced age. Annuitizing that asset adds another guaranteed income component to hedge against the scenario of long life, longevity risk. Do you see how these three components work together to provide retirement income and to do it in a way that addresses those risks? Okay, let's examine each of these three components in more detail. As described, the guaranteed floor is designed to provide systematic cash flow to cover daily living expenses. Sources of guaranteed income include Social Security benefits, monthly annuity payments, income from a part-time job, employer pension benefits, interest from a bond portfolio, or the maturity proceeds from a bond ladder, a reverse mortgage, or income from a rental property, and liquidating cash equivalent assets, such as a savings account or a certificate of deposit. Social Security retirement benefits are paid to eligible workers, their spouses, and dependents. Note that the monthly benefit is adjusted each year for the cost of living increases. So this portion of the guaranteed floor offers inflation protection. A private annuity is a contract between you and the insurance company. Your after-tax contributions, they grow tax-deferred until the monthly benefits are paid out. You decide the duration of the payout. However, given an objective of lifelong income, then you probably want to select the lifetime payout option. Each month, the fixed benefit amount is received. Part-time work or earnings from a side gig can supplement the income floor. Workers who participated in an employer pension, a defined benefit plan, for example, will receive monthly pension payments. Bonds are designed to pay out ongoing interest, typically on a semi-annual basis. The image on this slide depicts the structure of a bond ladder. The idea here is that a person can create a systematic annual cash flow stream by stacking bonds, with each bond maturing 1 year later. For example, bond 1 matures at the end of year 1. That money could be used to help finance the year 2 cash flow needs. If the money isn't needed, given maybe strong appreciation in the growth portfolio, then the face value amount could be used to buy a bond that matures in another 16 years. You are extending out the ladder for more bonds in the future. The reverse mortgage is a way for a person or a couple to monetize the equity in their home. To qualify for a reverse mortgage, the homeowner must be at least 62 years old with substantial equity in the property. The homeowner does not need to pay back the lender until the home is sold or the person moves out of the home for an extended period of time. Note that the homeowner will need to make property tax and insurance payments and is expected to maintain the property. There's also an initial cost for taking out the reverse mortgage. Income from a rental property is another example of systematic income. Given that annual rents typically increase, there is some inflation protection. The growth portfolio is intended to provide capital appreciation over time with inflation protection. Often, the retiree may view the growth portfolio as a source of flexibility for discretionary spending. For example, following a strong stock market year, the retiree may liquidate a larger amount of money from the growth portfolio to fulfill lifestyle wants. In a down year, the retiree may liquidate a lower amount simply to supplement any income gaps not covered by the guaranteed floor. The growth portfolio may consist of a taxable brokerage account, your IRA, or your employer retirement plan. Assets held in the growth portfolios may include stocks, both domestic and international, bonds, real estate, and other alternative asset classes. Often, investors will invest the growth portfolio in mutual funds or exchange-traded funds, which offer wonderful diversification, even with a low-dollar investment. When constructing your growth portfolios, you may want to consult with an investment professional who can help you identify an appropriate asset allocation given your personal and financial circumstances, that future financial need, your risk tolerance, your investment timeline, and investment knowledge. Remember, growth is necessary to extend the longevity of retirement assets. It's particularly important when the anticipated retirement period exceeds 20 or 30 years. Longevity insurance is simply a deferred annuity that does not get annuitized, paid out, until later in life, perhaps starting age 85. The annuity can either be inside or outside of your IRA or employer cash or deferred arrangements, such as a 401k, a 403b, or a 457 plan. For example, you purchase a private annuity with a life company, contribute funds, your after-tax dollars, which grow tax deferred, and then you decide when to start receiving the monthly benefits. Those annuity payouts hedge unexpected longevity and augment the loss of purchasing power in the guaranteed floor. One common strategy is to take perhaps 15% of the money that was available to go into the growth portfolio and put it over into the longevity annuity contract. Longevity insurance offers an inflation hedge and supplements the dwindling growth portfolios. In this video, you examined a 3-part retirement income plan that can help you create a reliable and sustainable inflation-adjusted income stream through retirement. This integrative retirement plan consists of 3 components: a guaranteed income floor, a growth portfolio, and longevity insurance. The combination is designed to balance your need to accumulate sufficient assets while managing the critical retirement risk of timing of withdrawals sequence, purchasing power, and longevity. Well, I hope that you found this practical knowledge video interesting and useful. Thank you for tuning in. I hope you'll feel empowered to use the knowledge in building your retirement income plan. I invite you to watch other Star and Standard videos that I've posted on the topic of retirement or on other pieces of the personal financial planning puzzle. If you found the content useful, then please tap the like button. Click the bell for future notifications and consider subscribing to the Star and Standard channel. Hope to see you in a future video.